Welcome to the Actionable Intelligence Alert. This is John Polemy. Today's date is Sunday, January 14th. I want to do a short video for weekly update on some of the things I'm watching in the market, the things that I think that are important. Back in early December, I did my prediction articles or my top idea articles for 2018, and one of them was on oil and oil stocks. It's obvious if you've been watching the markets or paying attention that oil has been down tremendously from its highs, over $100 a barrel. It traded as low as $18 a barrel within the last 18 months. And it has recovered now recently to a price, as you can see on this chart, up around $64 a barrel. That's for West Texas Intermediate. It's pushing $70 a barrel on Brent crude, and Brent crude is the European pricing. Right now, I think that longer term, when I mean longer term, I think over the next 12 to 18 months, we see oil go higher, $75, $80 a barrel. Right now, it's a bit extended. I expect a pullback. You can see the 200-day moving average and the 50-day moving average and how far above both of these the price is. I would expect to see the price of this oil to pull back down to 60, maybe even into the high 50s, and allow time for this relative strength indicator to move back down and digest some of these recent gains. But I think the things that are driving oil higher are the OPEC agreement to manage the production in a way that maximizes the financial effect for the OPEC members. They have been diligent in keeping the quotas. I also think that there's been a lot of discussion around, well, if the price of oil goes up, the shale producers in the United States are just going to ramp up. I don't think that's going to be the case this time, specifically because the banks, shareholders, bondholders, other stakeholders of these shale producers really have not been rewarded very well for investing in these companies. I mean, quite frankly, there's been quite a bit of research that has shown that the billions and billions of dollars that's been placed into shale investments, there's been no actual return. There's been no positive cash flow. There's been no profits. So I think that the initial euphoria that we saw a couple years ago has worn off. And now, after the price collapse that we had over the last couple years, people that own these companies or provide financing to these shale companies want to see more prudent management and want to see capital deployed in a positive way that's going to lead to some type of return. So I don't expect a big push for shale to explode just because the price goes up. It will. Shale production should go up. However, in the big scheme of things, you got to remember world oil demand is approaching 100 million barrels a day, and U.S. shale's 10 million barrels a day. And the United States, really, people forget this, is still a net oil importer. So I wouldn't get too worried about that. The fact is that what's driving the price of oil higher is the OPEC reductions in production, coupled with synchronized economic growth all over the world. I mean, this is the first time in probably a decade that most of the economies in the world, larger economies that is at least, are growing in a synchronous manner. And obviously when you have economic growth, energy demand goes up. And if the price has been limited because of the production cutbacks that we've seen, and you're going to see a higher price till we get to some equilibrium price. Speaking of that, I just wanted to review some of the stocks that we had mentioned that I had mentioned in the report. One of them was offshore oil driller, Ensco. You can see recently how it's just exploded from, you recommended it back in here, $5.75 range, something like that is where I was buying. But you can see it's exploded higher. It's way overbought here. Expect a pullback, but you can see the turn is coming. The bottom of the industry. I mean, quite frankly, when the price of oil collapsed over the last couple of years, there has been a real lack of investment in new production and new oil finds, and that is going to lead, I think, and a lot of other analysts seem to think, to a explosion in investment that's going to have to take place. I mean, oil, let's not forget, is an extractive industry. For every barrel you produce, if you want to stay in business, you have to find an additional barrel. If you haven't been investing in that because you had low or non-existent cash flows because of low oil prices, then you can understand that if you continue pumping oil, you will eventually go out of business if you don't find additional barrels. So I think that that's simplistically explaining it, but trillions of dollars of investment didn't take place because of the low oil price over the last few years. And that's going to be reflected, I think, as long as demand continues higher, will be reflected in a higher oil price. And I think what's going to happen here is the sentiment towards these oil stocks, these oil service stocks, is still not very good. People still are stuck in their normalcy bias, thinking that low oil prices are here forever. I think what you're going to see is, because of the higher oil price, you're going to see some higher earnings, higher cash flows being reported by oil companies, oil producers, and that's going to start creating a shift in mindset among analysts. They'll start upping their earnings forecasts, and I think you'll see a sentiment change, and you will see capital shift out of some of the other areas of the stock market and move into the energy stocks. So I think we've really caught this thing at the bottom. Here's another stock that I recommend to Junior. I really like this company, Jericho Oil. They basically, you can see right here, it's basically broken out of a range here. What I like about Jericho is they operate up in Oklahoma in the Canadian County and Kingfisher County stack play primarily. And what they did was, during the last oil downturn, instead of just pulling in your horns and not doing anything, they went out and purchased or made deals with people that were cash strapped to take over prime locations. They didn't do any additional drilling. They didn't do any development. They just bought up oil in the ground at very cheap prices. Excellent idea, totally contrarian, love the management, and I think this is really going to pay off if oil prices go higher. There's a big family involved up in Oklahoma, I believe, or Texas, moneyed family that's really involved with this stock. The management really knows what they're doing. They made an excellent call in just buying these distressed properties, and now I think after those trees have replanted during the last downturn, we're gonna reap a big harvest here if the oil price continues and they develop these properties. They are in pretty prime locations up at, like I said, in the stack play in Kingfisher. When I say stack, you're talking about multiple levels of oil resources in the same acreage. And that's many larger producers are operating in that area, and Jericho is able to get involved in some properties in that area. So excellent stock to get involved with. So one of the other thing I wanted to talk about was something that I look at to determine where I think oil prices are going to go, is something that was mentioned in my article at the start of the year, and that is this chart here, which is the comparative inventory versus oil price. And let me just explain this real quick. Basically what this shows is, you're talking about comparative inventory. And when we say comparative inventory, it's talking about all the liquids, crude oil, natural gas liquids, diesel, gasoline, all the basically liquids, petroleum products. And what they do is they compare the current reporting that comes out every week, compare that to the 5-year average. And what we see here, based on some regression analysis that people have done, is that here you have like the zero. So if the comparison was equal to the 5-year average, you'd be at 0. And if it's positive, you see it here. This is in millions of barrels, obviously. This would be 50 million barrels, 100 million barrels, 150 million barrels positive of the 5-year average. This is negative, and this is the price of WTI, the oil price. So what you see is, as liquids, the comparative inventory of liquids, petroleum liquids in the United States, goes down towards 0. Now, remember, in comparison with the 5-year average, the price, it's a scatter chart, you see, so it's not exact dead nuts on, but you can see that it does trend higher. And as you get to the zero area, you see the price getting up into 80, 100, 120, 140 as you get down to even as low as between 0 and negative 50 million barrels in the comparative inventory. You see the price can really get pretty high. And the reason this is because oil is priced at the marginal barrel. If the total demand, let's say, is 1 million barrels, the millionth 1 barrel, 1 million 1 barrel is what determines the price for the other million barrels. That's how the price is set. So if you're in a situation where the demand is exceeding supply and inventories are decreasing, then the oil price does go up. And this is an older chart, of course. I follow it in real time. Guys like Art Berman, he reports this on a weekly basis on Twitter, and there's a guy on Seeking Alpha that does the same thing. So, and what we've seen is the comparative inventory decrease on a weekly basis, and that's why we've been seeing the oil price go up. It's pretty simple economics 101, supply and demand, but I think it cuts through a lot of it's a data set that I've found that has worked pretty well, and it cuts through a lot of well, this is what I think is going to happen, or what the Russians are saw. I'd like to get down to one factual statistic that's been that's worked really well, and this is the one that I follow. So I'll probably be referring to this some more as we go forward, but this is the thing to be looking at. And as long as we do not see a major recession in the world or a psychotic break like 2008 in the markets, I think oil is going substantially higher. In addition, all commodities, and I don't have time to talk about all the commodities today, but we are in the late stages of an economic cycle. We are in the late cycle of the stock market. We've had 9-10 years of going on 9 years of economic growth. We've had a bull market that's been going on since 2008. These things are long in the tooth, and at the late cycle, what you see is a shift to commodities. What you see is a shift to natural resources, and that's what we're seeing. And oil being one of the primary commodities that's going to respond. I don't have time today to get into it, but I think the demand in the emerging markets, especially in Asia, not just China, but nobody talks about India or some of these other countries that are developing. Oil demand is surging in these places, and I think it's going to continue to do that. So the oil price is looking good. I think it's short-term overbought. I probably wouldn't be putting on any more positions right now. I think we can look forward to a pullback, but we may not get that. Hopefully you've established your positions and you're already in the green in some of these picks. But I do expect going forward over the course of 2018, barring, like I said, any type of economic contraction or recession or things of that nature, I expect the oil price to move higher. So that's it for this week. Thanks for listening, and we'll talk to you next week.